Good morning, everyone, and welcome to our DATIQ weekly market update. This is our update for November 14th, 2023. I'm Ken Animo, Chief of Analytics over here at DAT, hunkered down in my basement with a bunch of sick children. I'm joined by Dean Croak, who's our Principal Industry Analyst, who probably doesn't have that problem right now.
No, but we used to, not too long ago. But we've got different challenges today as they grow. Kids always seem to have something going on no matter what age.
Yeah, I think my wife and I had a combined 45 minutes of sleep last night. The baby has like teeth coming through, so it was just like, you know how it is.
Time flies though, Ken. It's you think it's like lasting an eternity, but before you know it, they'll be driving cars and getting into all sorts of trouble.
Look out.
Yeah.
Well, I won't miss this phase, I'll tell you that much. I won't miss the drool and sick phase, Bring me on the getting pulled over for going too fast in a car phase. But enough of that. It must have been a boring football week, Dean, if this is what we're talking about this morning. The Ohio State game was practically over in a quarter and a half, so I don't have much material prepared to riff on this morning. So
yeah, I've got none.
It's just the two of us this morning, for those wondering. We don't have a guest, so Dean and I are going to get into some market cycle things towards the end, but go ahead and fire your questions off. We'd love to have a little bit more of an open dialogue today. But with that, I'm going to jump into our key points of the week so we can get moving along here. Key trends we're watching. So reefer spot rates are climbing, while dry van and flatbed, not so much. Dean's going to expand on this, I'm sure, but the trend is rather concerning compared to where we should be seasonally. Much more so when you look at load board activity, which is this next bullet point. But we saw a decline in load post volumes last week and an increase in truck post volumes, which kind of work against each other to drive down load to truck ratios. On the good news front, October's LMI expands for the third consecutive month after 3 months of contraction. And then Michigan State's truckload ton mile index up 6% in September, down 1% year over year. Demand still in a trough. I think that's a pretty succinct way to describe the current market that we're in. So I'm going to turn it over to Dean now, and he can walk us through the market update. Dean?
Yeah, thanks, Ken. Yeah, Jason Miller had a LinkedIn post out this morning about the latest TTMI. You should catch that. It's a really interesting read and kind of reinforces the fact that we've got quite a lot of mixed signals in the market. So let's start off with load to truck ratio. Spot market volumes dropped last week against seasonal trend. Normally they start to go up in dry van towards Thanksgiving and the end of the year, but down, it's sort of the largest single week decrease we've seen in a long time, down 20%. Load to truck ratio sitting just under 2 at about 1.65. That's a fairly low level for this time of the year. In refrigerated, volumes typically increase this time of the year. Last week, they backed off a little bit, backed off about 13% week over week. Normally, we see a 7% week over week increase in week 45. So definitely going against trend in the refrigerated category. Of course, that's impacted by lower produce volumes out of California, down about 20% year over year. Load to truck ratio sitting about 3.17. And in flatbed, after being relatively flat since July 4, the volume of flatbed load posts also decreased last week. They dropped 15%. That's the lowest we've seen for many years in week 45, and also about 36% lower than this time in 2019. The load to truck ratio for flatbed sitting at 4.95. Having a look at some of our markets, top 5 markets, always like to look at those. They're a good bellwether for the total market. We see about 25% of our load post volume in the top 5 states: California, Illinois, Georgia, Texas, and New Jersey. New Jersey was the only market in the top 5 that reported a rate increase last week. Rates are only up a penny per mile, though, averaging $1.41. In the other 4 states combined, rates dropped 3 cents a mile, averaging $1.72. That's just 3 cents a mile higher than in 2019 for the top 5 spot market states. Of course, solid gains reported in the Pacific Northwest, where produce season and Christmas tree shipping seasons are in full swing. Outbound rates in Washington and Oregon were up last week, up 10 cents a mile, averaging $1.47 for dry van. Remember, folks, these are line haul rates excluding fuel. Last week's increase in the Pacific Northwest follows seasonal trends, though, so no surprise this time of the year rates have about another 25 cents, maybe as high as 35 cents a mile to go before peaking at the end of the year in that part of the country. Seattle reported 22 cents a mile increase last week, averaging $1.96 for outbound loads. Portland, carriers were paid on average $2.04. Other markets worth noting, Indiana spot rates were identical to 2019 at $1.91, up 3 cents a mile last week. Staying in the Pacific Northwest for the refrigerated market conditions index, Pacific Northwest had some of the hottest results last week. Of course, fall produce Christmas trees are boosting some of those volumes. Regionally, carriers were paid an average of $2.31 for outbound loads. That's up 16 cents a mile. That's also the highest rate outbound in the Pacific Northwest for this time of the year, outside of 2020 and 2021. So certainly some good results up there for carriers. Solid gains reported in Pendleton, a very large refrigerated market. Rates averaged $2.08 and $2.11 a mile on the long haul lane to the big warehouse distribution market in Allentown, PA. Having a look at California, reefer rates increased 3 cents a mile. Outbound California averaged $2.25. Solid gains in the large Fresno produce markets, rates up 10 cents a mile to $2.30. In Texas, in the southwest, reefer line haul rates were flat at $1.79. Further east in Florida, spot rates jumped 7 cents a mile, only averaging $1.21 northbound. That's about 3 cents a mile higher than this time in 2019. And in Minnesota, the number one state for a lot of stuff going on right now in the Christmas, the lead up to Christmas, but mostly around Thanksgiving, particularly turkey volumes. Spot market rates up 9 cents a mile for refrigerated carriers to $2.41. Next door in Wisconsin, carriers were paid an average of $2.57, up a penny per mile. And having a look at flatbed, of course, Washington State, solid volumes again, mostly Christmas tree production, rates up 20 cents a mile for outbound loads in Washington, averaging $2.48. At that level, spot rates have increased about 35 cents a mile for flatbed carriers in the last month. Some of the busier lanes, Seattle to Stockton, California, averaged $2.48 per mile last week. That's the highest since February, and about 50 cents a mile higher than this time last year. In Nevada, spot rates up 18 cents a mile, averaging $2.39, while in Wisconsin, spot rates increased 30 cents a mile to $2.32. That's significant because in Wisconsin, flatbed rates had been dropping for the previous 4 weeks. Next door in Michigan, outbound loads paid carriers an average of $2.38. That's up 9 cents a mile compared to this time in 2019. And wrapping up our market update with a look at the year-over-year spot rates at $1.57 a mile. Remember, folks, these are line haul excluding fuel. At $1.57, dry van line haul rates have been flat mostly for the last 7 weeks. They're about 15 cents a mile lower than this time last year. And as you can see from the chart, sitting about 4 cents a mile higher than in 2019. That's the lighter green color on the chart. Compared to the top 50 lanes, they averaged about $1.86 a mile last week. That's based on the volume of loads moved. The national average of $1.57 is about 29 cents a mile lower than the top 50 lanes. In refrigerated, spot rates up about 3 cents a mile last week, building on the prior week's 5 cents per mile gain. At $1.95, reefer line haul rates are up 8 cents a mile in the last 2 weeks, but sitting about 14 cents a mile lower than this time last year. And lastly, in flatbed, line haul rates for flatbed lost the most ground last week. They dropped 2 cents a mile. At $1.87, flatbed line haul rates are 16 cents a mile lower than last year and sitting about 5 cents a mile higher than 2019. That's it for this week's market update. The long form version of today's market update will be published this evening. Just go to dat.com/market update and download the full version of the report. Over to Ken for the short-term forecast.
Thank you, Dean. So this week, we're going to see a lot of seasonal pressure. As we've been talking about, we get closer and closer to Thanksgiving and then eventually the Christmas holiday. So this chart, we always start with dry van. The blue is the historical 7-day weighted moving average. We go back a little ways to give you some context. This goes back to June. And then we have 4 forecast models. We have a short-term forecast that's in red. We have a green, which is our ratecast model. That's in all of our products. And then we have kind of 2 intermediate models that are crossed between the long and short-term models. As you can see here, those intermediate models are very well aligned with ratecast, just given how dominant seasonality is this time of year. They're all 3 a bit more optimistic than the short-term model, which is essentially picking up on the most recent uptick and extrapolating that out almost in a linear fashion over the next several weeks. Let's go to Reefer. So this is probably as aligned as you've seen these models all year, short of the absolute peak of spring produce. What you see is things culminating in Thanksgiving the week after, and then dipping back down. What's interesting is you're starting to see the back end where we start to bump back up heading into that week or two before Christmas. And all four models are in very tight alignment as to what's going to happen here, which is pretty much what you would expect. Lastly, we have flatbed. Not much going on here. It's hard to even distinguish the models apart. I will say that you're starting to see a little bit of a tail up towards the end. This is when a lot of drivers, especially flatbed drivers, might go out of service, which will constrain capacity a bit and lead to slightly higher rates. Nothing crazy, right? We're only talking about a few pennies here, but it is at least starting to tick a little bit upwards as we head towards the end of the year. So that is our market update and forecast. Let's turn over to Dean for our question of the week.
Yeah, Ken, when we were at DATCon, we were about to go on stage and I asked you a question about margin compression, and I'd never really thought about it. We talk about it from a broker's perspective a lot, but margin compression is also affecting carriers right now. And I thought you had a really good explanation for brokers in particular, how it happens. Not so much for carriers, because I'm not sure they think about market cycles in the same way. But, most freight cycles bottom out like this. Do you think this cycle is any different in terms of margin compression?
No, first of all. In my mind, at least, it might not be easy to explain without a whiteboard, but I think of it like, if you think about a high-low matrix where you grossly oversimplifying it by saying things are either high or low, right, and you do a 2x2 of margin and volume, and then high-low for each. That gives you 4 possible climates, right? So just to level set, you could have high margin and high margin and low volume, high volume, low margin, low volume, low margin. I think I got all 4 there, but you get the point. Those are the 4 different combinations. What you see is the market is coming down. So when it's coming off of this peak for a broker, you have the volumes tend to come down a little bit, but margins are expanding. Why are margins expanding? Because any broker that has any contract freight will have priced it forward. When we say price forward, that means somewhere in the past you priced based on the conditions at the time, and you locked that in. The market has fallen since then, and those margins are higher than when you priced and moved that freight initially. Think about it. Think about your house in the opposite direction. Most of us who got a mortgage in the last few years are now experiencing interest rates that are substantially lower than current market rates. People that lock in now will probably refinance in a few years because the rates will have fallen and their rates will have been higher. You can think of refinancing as going out to bid as a shipper. They go out to bid periodically. Imagine if you had to go out and kind of refinance your mortgage every year. So that being said, as the market's coming down, you tend to have a lower volume, higher margin part of the cycle. What happens now, as everything's been generally rebid from the COVID highs, you have lower margin, if not low margin, and low volume. That's why, broadly speaking, that and the increased cost of capital are why you're seeing a lot of brokerages get into serious financial distress or bankruptcy. So margins have compressed, both in terms of a percentage and a dollar basis. The little wrinkle here is when the market's absolutely at its total peak, broker margins as a percentage are pretty low, but as a dollar amount per shipment are very high because the rates are so high. So as we sit now, revenue per shipment's down, margins down, volumes down. And that affects carriers and brokers in a pretty negative way. So that's a lot to explain. Did I make any sense, Dean?
Yeah, absolutely. And I think one of the differences this cycle is the length of the cycle, right at the bottom of this trough that Jason Miller talks about. It seems to be longer than certainly we anticipated. But compared to prior cycles, do you think this is any different in terms of the transition period?
It's tough, right? I think capacity not exiting as quickly as we thought is the main reason why the market has stuck. I just think it's pretty much a mirror image of what we saw during the high times in COVID. I think that's what's hard to swallow is I think a lot of folks may have been wishfully thinking that the upcycle would have been generationally positive and the down cycle would just be normal, which I don't think is a possibility. Now, I will say that we expected the rubber band to snap back, but to your point, Dean, maybe not as severe as we sit now. And I think I would have expected at least a little more seasonality. Some of the early reports I was reading this morning, consumer spending heading into retail shipping peak and not great. So I think some of the concerns we started voicing several months ago, as we were rounding into school starting back up, around that destocking being a bit of a red herring, I think that might actually end up being true. That the grand destocking that everyone was anticipating maybe wasn't going to happen, at least to the extent that some folks were anticipating.
Right. Yeah, on the carrier side, it's interesting. We were looking at some numbers yesterday, and I think it's hard to quantify, but I think most of us probably underestimated how much profit carriers generated during the pandemic and how much debt that was they were able to pay down. And that gave carriers a fairly long runway. I suspect there's a lot of carriers out there now that can operate way below the average operating costs for a long-haul spot market carrier of $1.87 a mile. I suspect there's a lot of carriers out there that have paid off truck and trailer and can save about 30 cents a mile on their operating costs and run for, somewhere in that $1.50 to $1.55 a mile, which is below what the line haul rate is right now. On top of that, I think we've seen a much higher uptake in the use of fuel discount cards, bulk buying power at the smaller end of the fleet. We launched our DAT1 fuel card last week with our partner OTR Solutions. So that shaves off about 6 cents a mile in operating costs by buying fuel at a discounted rate. I think there's been a lot more carriers take advantage of fuel cards in the last 18 months because of the surge in diesel prices. So I think there's we look at average operating costs. I suspect those carriers that have been or that are left in the market right now on the smaller end of the market, and I'm talking mostly owner operators and very small fleets in that sort of 1 to 5 range, are getting by much better than we would have anticipated. I think there's a band of carriers probably in that 40 to 150 range that are probably struggling the most. But that's sort of, we've still got a split market. I think there's still an exodus of carriers underway. We saw the third highest number of carriers exit the market in October. It's too early to see what the trend is going to be for this month, but we'll no doubt report on that as soon as we can. So
I think there's a question in the chat about rates being so low, and I'm sure that's a question on everyone's mind. It's something we touched on in previous shows, but I think it's worth mentioning here again. Rates are largely bounded over it's important to think short and long term where rates are bounded. Because I think intuitively, especially if you're on the carrier side, you might be sitting in your dispatch office or in your truck thinking, how can the market sustain for any shipment a price that's below my cost? And I think you need to break it into 2 different pieces, because that thinking is absolutely correct over a long arc of time. So over a long arc of time, rates have a floor that approaches the total all-in cost to operate the average fleet. So it might be higher or lower than your particular cost, but if you look at the average cost to operate that Dean reports on, the rates that are out there in the market will approach, but should not go below, again, over the long arc of time, that total all-in cost to operate. Over the short arc of time, the general floor, the sarcastic way to say it is the floor is, the least intelligent person to accept a shipment, right? I think that's kind of the sarcastic way. It's kind of true, but and when I mean intelligent, I mean aware of their costs. But over kind of a short-term period of time, those costs bottom out at the variable cost to operate the truck, right? So long-term, they bottom out at the all-in cost. Short-term, they bottom out at the variable cost. Well, why is that? Well, let's just say that you are spending every month with your monthly expenses 100% of your monthly take-home income, right? You pay your rent or your mortgage, you pay your car payment, you buy your groceries, you're spending it all. Well, what happens if you have an unexpected medical bill? You're in trouble, right? So think of the same thing for a trucker. Dean talks about this all the time. Think about what if your head gasket blows out on your engine. I'm assuming diesel engines have head gaskets, like a gasoline engine. But let's say that happens, or you need new brakes or tires. Something that's not part of your recurring kind of your per mile or per month expenses.
Okay.
That's the all-in cost over a long term to operate a truck. So that's why I think we've been seeing a slower attrition, because to Dean's point, they've saved up some money, and it's little events here and there. Wouldn't you agree, Dean, that are popping these trucks out of the market?
Yeah, and I think that it's kind of a really nuanced situation, Ken, because we had a lot of carriers join the industry during the pandemic, and they paid upwards of triple for a used truck. And I remember looking at the time, the average used truck was something like 63 months and 500 and I'm going to say 30,000 miles. And for a lot of those trucks, if you're entering the market with a truck with that age and it's a newer model truck with emissions on it, you're probably out of warranty. What you're going to end up with is a truck that's not going to last as long, and one that's going to cost you a lot more to run on a cents per mile basis. So what's happening to a lot of those carriers right now is they're financing a much higher bill than what the truck's worth on the open market. Plus, they're being hit with much higher operating costs. And then on top of that, it's hard to get trucks in and out of workshops in a reasonable amount of time. So the opportunity cost is much higher when you think about you need to be running a truck at around $1,200 to $1,500 per truck day. Every day sitting in the shop becomes very expensive with these used trucks that are not as economical as you might think because of the amount of downtime that carriers are going through. So that's where I think there's carriers that I have, and I'll use some anecdotal evidence from friends of mine that run freight. You know, they will look for freight off DAT load board. Now, in freight in inverted quotes, they will look for freight because they're already being paid for their backhaul. So their round trip rates are affording them the luxury of a much lower backhaul rate using our load board, because for them it's pure profit. They're already being paid for that rate. And some of these loads that they're running backhaul is, you're well over 1,000 miles. So it's not like this is a regional short haul play. They have a freight mix that's incredibly profitable because they're so specialized in what they do. I remember a carrier at a truck show said to me, I'm part of the low rate problem because I will accept low rates to get back home because I've got really profitable rates on my outbound head haul with my hometown shipper. So I think, a lot of carriers do sometimes justifiably complain about low rates, but a low rate to one carrier might be incredibly profitable compared to another. So it's not just the same rate applies to everybody. It really depends on the individual circumstance that they're in. But I think the bigger picture, the numbers I saw, Ken, was that carriers were making, at the peak of the pandemic in late 21, making as much as $100,000 a year profit. Now, that didn't last for too long, but over the course of the year, it was around $70,000 gross profit for that year on top of driver wages. That pays down a significant amount of debt. And I think that's what was underestimated in 2022 when people were calling for a bloodbath. That was far from the case for a lot of carriers that had either sold equipment that was worth a lot more than what it is today, or they'd paid down a lot of their debt levels and can afford a much lower operating cost today.
Yeah, I mean, ultimately, where we sit today is kind of being guided by the interest rate conversation, I think, on a go-forward basis. Interest rates and fuel. All right, so if you're going to separate kind of insular market dynamics and seasonality, I think that's something that we have a pretty good handle on. I think the big unknowns continue to be energy prices, which we all know are impacted by tensions or geopolitical things in the Middle East, and then interest rates, which are largely impacted by a bunch of old people in a room once a month who set federal open market policy. No offense to our federal government. But you get my point, right? Jerome Powell spent the better part of 2 years denying inflation existed and then raised interest rates at a pace that hasn't been seen since like the Great Depression. But those are going to be, I think, really I'm curious to see what the 3-year journey looks like the reason I brought that up. I'm curious to see what the 3-year journey of a truck, an owner operator that enters the market brand new right now looks like. Because it's one hell of a tale if you entered 3 years ago, right?
Right.
And I think it'll be really interesting to see like what it would look like if you entered now under an environment where you haven't got these financing terms on a new truck or used truck, Dean, since 2000, right? Does that sound right? I mean, when have interest rates been this high in the modern era?
Yeah, many years ago. I can't remember that long ago.
I would say like for a prolonged period of time, it was the very early 2000s before the dot-com bubble.
Yeah.
So, in a way, this is unprecedented times to get into the market because you're essentially financing a higher cost per mile over the life of your business at this point. So
the flip side of all of this is if you're entering the market now, one would assume that you've got a pretty good handle on operating costs because the margins are going to be so tight. I'm also seeing a lot more guys learn how to wrench, how to do their own repairs. A lot of guys are being forced to do that because of the lack of availability of workshop time. It's hard to overestimate how important it is to understand your own operating costs. But one of the biggest savings, other than slowing down, is doing your own maintenance. I'm seeing a lot more guys coming back into the market now, learning how to do that, to work on their own trucks and trailers. That can save an enormous amount of money and time.
Cool. Any other questions we have here?
One about starting a business in Canada. I don't know that we've got any data to speak to the profitability of a business in Canada from Shaitan. I could probably refer them to some people up there, but no, I don't have any answer to that.
Let's get Chuck Snow back on.
Yeah, I was almost called Chuck this morning. So yeah, we need to get him back on shortly. He would know the answer to that. I suspect he'll probably say, make sure you understand your operating costs. There's probably opportunity, but I'm not sure where it would be in Canada. All right.
Anything else?
No other questions. Got a few shout outs though, if we want to cover those.
Let her rip.
Yeah. Sales chatter tomorrow with Dan Deegan, as always, 11 a.m. Eastern. Robert Rouse is on Landline Now, Sirius XM at 7 p.m. tomorrow night. Really interesting discussion with Dr. Zach Rogers coming up on the Freightvine podcast. Chris Kaplis is talking to Zach. He's the architect and publisher of the Logistics Managers Index. He's going to be talking about the expansion of logistics for the third consecutive month. That was our bullet point at the top of the show. He's also going to be talking about on the podcast market impact of recent bankruptcies and the recently resolved UAW strike. We've got a very important guest next week on our show, Tim DeNoyer from ACT Research. He's also the author of the CAS report. We'll be talking about the latest numbers for new truck and trailer orders and what this means for supply next year. Tim also has a long-term freight forecast we'll be talking about. With that, it's back to Ken to wrap up the show.
Thank you, Dean. I don't have any specific plugs here next week. We'll be doing a show. That'll be our Thanksgiving special. Maybe I'll dress up like a turkey. I don't know, something like that. I think I have a turkey T-shirt that I traditionally wear. And then we'll have to schedule, Dean. This is less of a plug and more of a reminder. We'll have to get Dr. Kaplis on for our kind of end of our year prognostication show for wrapping this year up and looking forward into next year. I think that would be fun. Maybe we'll tie that in with a long-term forecast run. We took a peek at just the drive van long-term forecast earlier this week, and it's pretty remarkable how dead on it's been the last 5 weeks. So it'd be interesting to see and kind of dissect what it's going to look like next year. It's always a good time to run these as we're finishing off this year strong. So with that, we are going to sign off for this week. We will see you next week, and we all hope you have an enjoyable and safe week. Bye, everyone.
Bye, everyone.